There is no model out there that predicts Bitcoin goes down over time. Some of them taper, like Bitcoin 24 from Sailor, but every other model, stock to flow, power law, everything is numbered go up. And I think that is the direction it's going to go. So people just have to realize you can be bearish, you can think it'll go down, but just remember, it'll go back up after.
The past week has been brutal for the crypto market. Volatility has returned with force. Bitcoin has slipped below key psychological levels. Liquidations are piling up. Realized losses are now approaching extremes reminiscent of prior bear market stress events. Sentiment once again has fractured into two familiar camps, those calling for structural collapse, and those arguing this is simply another violent phase in Bitcoin's long history. Against this backdrop, Samson Mow recently made a striking observation, one that directly challenges the emotional reflexes dominating today's market. Bitcoin's long-term trajectory, he argues, has never been convincingly modeled as a system trending toward permanent decline. Yes, corrections happen. Yes, drawdowns are severe. But across stock-to-flow models, power law analyses, and adoption curves, the dominant thesis remains consistent. Bitcoin is structurally designed around scarcity and increasing utility, not decay. And that distinction matters now more than ever, because during every period of market stress, the same criticisms resurface. Claims that Bitcoin was never built for number go up. Claims that it has no real utility. Claims that its growth is driven purely by speculation rather than function. But beyond these philosophical debates, newer fears have also crept into market psychology, including renewed concerns about quantum computing risks and long-term network security. What you're about to watch is not another price prediction video. This is a deeper breakdown of two forces shaping the market right now. First, we bring you Samson Mow's response to the recurring doubts surrounding Bitcoin's utility, resilience, and long-term design. And later, Jeff Park's structural explanation for why price action has become this unstable, even without a clear crypto-native collapse. If you want to understand what's really happening beneath the volatility, not just the noise, watch this video all the way to the end. And if you find this analysis valuable, make sure to like the video and subscribe. Thanks for the support, and enjoy the video.
I like Maddie, but I agree with him that Bitcoin is not designed to appreciate in price. The appreciation in price is a function of the scarcity, which it functions the same as anything else that is scarce, real estate, precious metals, etc. So it will go up because there is increasing demand, and it will go up because there is utility to it, which is what he identified as what it was created to be: decentralized, permissionless, uncensorable money. There is great utility in that function, especially today, in this day and age, where you're seeing more and more attempts at asset seizure. So one of my predictions for this year was that Elon Musk is going to come back to Bitcoin. And this is because in California, they're trying to pass the wealth tax, right? And a lot of his friends are from the all-in podcasts, like David Sachs and Chamath and those guys, and they are feeling this pressure. And Elon knows that too. It's just whenever he has cycles to really reason through this thing, I think he's going to make the same conclusion, because you can run from asset seizures, but to a certain point. Like, people are moving to Texas now, but what happens in 10 years in Texas? Does it become blue? I don't know. Nobody knows these things. Or will they try to change the law to tax wealth and unrealized capital gains? Because what you're fighting is a core system of human civilization, which is people that want to take and believe that they can take indefinitely when you can't. Like, money doesn't grow on trees. And this is what we're finding. Like, it doesn't. And hard assets are repricing the world. And in repricing the world, this is where you see hard assets appreciate in price. There is no model out there that predicts Bitcoin goes down over time. Some of them taper, like Bitcoin 24 from Sailor, but every other model, stock to flow, power law, everything is numbered go up. And I think that is the direction it's going to go. So people just have to realize you can be bearish, you can think it'll go down, but just remember, it'll go back up after. Even as the most staunch bear, you cannot think it's going to go down and go to zero unless you're just oblivious to the world today.
I also believe that there is very little chance that Bitcoin will ever go to zero. There is a concern that that scenario could potentially happen. It came up lately in conversations online, the quantum threat topic. Essentially, Nick Carter put out this post commenting on the fact that a famous asset manager basically removed Bitcoin from its portfolio and reallocated it to precious metals because of the concern that eventually quantum computer strong enough could break the encryption model of Bitcoin. The market feels the pressure of this potential event happening in the future, and it's pricing in the event of a quantum day coming soon.
I mean, in labs today, they can replicate gold out of lead. I don't see the boomers worried about that. That is a bigger threat to gold than quantum computing is to Bitcoin. I don't know why people listen to Nick anymore. He's investing in companies that are helping crypto projects transition to post-quantum. I mean, he has motivations to say these things and instill this fear in the market. But quantum computing is not a threat. I was looking at this TikTok video the other day, like some guy put a picture of a hole in the floor of an elevator, and then the guy coming into the elevator looked down and saw the hole in the elevator and he like panicked. That's how I view the quantum drama right now. It's like some people put this picture of a hole in the floor and people are looking at it and going, wow, it's scary. We're going to fall in that hole. But again, like the threat of quantum is not to Bitcoin. It is to everything else. Like the entire banking system, all of this infrastructure, encrypted government sensitive communications. This is all going to be destroyed when quantum computers arise. And I think the Bitcoin network will be able to upgrade far sooner. And we already have a number of mitigations that can be deployed relatively quickly. When there is a clear and present danger to Bitcoin, the Bitcoin nodes, the plebs, the network, they upgrade very fast. And it's not going to be like a slow fix that's going to take years. And we also have preventative measures too. Blockstream has a lot of research underway to mitigate the threat, but the threat does not exist in any form factor today that is remotely credible. All of the quantum computing marginal threats are them directing the quantum computer to find the answer and showing the computer this is what the answer is, and then it can get there. So that's the state of the quantum computing world today. And yes, it can accelerate quickly, but it's not the biggest threat to Bitcoin. The quantum computing is not the biggest threat to Bitcoin. Quantum computing is the biggest threat to everything else, because Bitcoin will be the resilient functioning network. There's a show on Netflix which was called Zero Day, and that was when a lot of banking systems were shut down because of hackers. But if you think about the quantum threat, it is not that someone's going to use a quantum computer to hack your bank account, Giovanni. They'll just shut down the whole banking system and nuke it from an external threat actor. And that will be the end of the banking system completely. So no one seems to be worried about that. So everything is directed to Bitcoin only, but I just don't see it as a rational conclusion. The other point too is that we don't need to rush to fix a quantum threat, to address the quantum threat that does not exist, because that can have unintended consequences. You can change the cryptography to a different algorithm, and maybe that is not quantum safe in the end. We don't know. So rushing a fix out is actually the most dangerous thing to Bitcoin, especially when the threat does not exist. And a lot of the quantum threat is mitigatable. You just need a key path a spend key path that will be upgradable later on to spend your Bitcoin. And that key path doesn't need to have the signing mechanism defined today, but as long as that path exists, there is a way out. But the biggest danger is rushing some fix in now that actually makes Bitcoin breakable by classical computers, not quantum computers. So there's a fine line of balance between protecting the network by having a quantum resistant cryptography and adding some cryptography in there that is vulnerable today.
Mow's argument ultimately reframes a critical misconception driving much of today's fear. Bitcoin was not engineered as a speculative asset designed purely for price appreciation. Its appreciation, he explains, emerges from something far more fundamental: scarcity combined with growing demand and utility. Just as with real estate or precious metals, price expansion is not the purpose, but the consequence. The utility, decentralized, permissionless, uncensorable money, is the engine. The repricing is the effect. And this becomes especially relevant in an environment increasingly defined by financial repression, shifting tax regimes, and rising concerns around asset seizure. In Mow's view, Bitcoin's value proposition strengthens not during euphoria, but during structural uncertainty, when trust in traditional systems begins to fracture. But while Mow focuses on Bitcoin's long-term design and resilience, another critical question remains: what is actually driving these violent sell-offs? Because if Bitcoin's core thesis hasn't fundamentally changed, why does price action look this unstable? This is where Jeff Park's analysis becomes essential. Rather than pointing to crypto-native failures, Park argues that much of today's turbulence may be emerging from outside the crypto ecosystem entirely, from the growing integration between Bitcoin and traditional financial markets.
I think when you zoom out, what has happened really is that, one, Bitcoin is now just a bigger component of being integrated into global financial markets, first and foremost, which we should all celebrate. We wanted Bitcoin to be a part of the fabric of the capital markets, and it has succeeded in becoming that. And two, what that means is that there's just going to be non-crypto related events that also spill over into driving price action in crypto. And I think we are seeing different interactions emerge out of that context window. Just to kick things off, I've said from the very beginning, when the Bitcoin ETFs launched, that it would really be a historic ordeal. And the reason is because the ETF market is far more diverse and prolific in its volume and types of financial engineering and activities that can be brought upon from the architecture that Wall Street is very familiar with, and that it would revolutionize how we think about kind of Bitcoin being adopted, not just for people who buy and hold, but those who are intending to use it as speculative vehicles or insurance vehicles for other parts of their portfolio construction. And Bitcoin options in particular has found a really robust product market fit. And what we saw on February 5th is we actually had the record-breaking number of IBIT options ever traded in the history of this launch. It was almost close to 3 million contracts. And that is very, very substantial from the perspective of the fact that it's not even actually more than just a year and a half old. And that's how much people have come to speculate and take positions in Bitcoin in a short amount of time. The other thing that happened is the volume was record-breaking too. Over $10 billion traded in that one day. And it is the most volume ever traded for IBIT. So all this kind of points you to the fact that the Bitcoin ETF is at the center of a lot of trading activities. And that's kind of where I began my journey. Like, let's understand who's trading this, who are the holders today, what does that cross-section look like over a period of time, and is there anything kind of we can discover in the attribution of the buildup of those positions over the past 9 months? And most critically, kind of looking at it through the lens of October 10th, which is when the biggest liquidation event last year kind of had some cascading effects towards reduced volatility and volume in the space. And that's kind of, where we began my journey to explain what happened on February 5th. That's at least my current working theory. And it's really because I believe the catalyst did not come from crypto. So just going back to 1010, I think it's important to kind of think about October and on, where two things happened. One is, as you mentioned, the wealth destruction in the altcoin complex and crypto native at large was pretty dramatic. And I would say that ever since then, volume never really recovered in an organic way. And even entering the new year in January, volume was abnormally low considering how strong it should have been. So I would say there is some element of wealth destruction from 1010 that didn't allow natural demand to be created. That I think is true. The second thing, though, is also you have to remember it's around that time, September, October, November, December, when you start to hear JP Morgan, Morgan Stanley, and all these banks come up with structured product issuances. And it's really from that point on too, where implied volatility never really got very high. Vol never really was able to reset back to the healthy levels that we had at the beginning of the year. And so there are two different things that are happening, right? You got the crypto native story, which is there was some liquidations and bad protocols and there was a blow up and people lost a lot of money. But the other thing that happened is in the Wall Street land and in the kind of private wealth management industry, there were these structured product issuances that were coming online that are what I would call net vol sellers, right? They're in the business of selling vol to turn that into some kind of yield component and monetize a coupon and some partial performance to Bitcoin upside. And that's a big complex. It's hard to say that industry is at this point so big that they would be like the overwhelming recursive like cause of a blow up. But you can imagine they start putting in some different kind of risks on the volatility surface over time where those things can accelerate if kind of triggered in the wrong way. So I think it's also important from October and on, we probably are layering some of these structured product issuances that are creating some volatility gap holes thereafter, where volatility is being sold and suppressed. The reason I think in the end of the day is it's probably coming from a spillover from TradFi is because it is more likely to me what we saw was a big deleveraging event in that world than it would have been from the crypto complex on February 5th. Because to your point, most of that already had happened. There really wasn't that much kind of more deleveraging I think you can do in February. And so the kind of violent sell-off I think really came more from the contraction we saw in the open interest in the CME futures, the contraction we saw basically across options and the roll-off from December. So the other thing that happened is open interest in Bitcoin options in the ETF world never really kind of picked up after the expiry and roll-off from December. We're kind of in a pretty uniquely clean canvas where people are going to have to start rebuilding some positions. And the most notable flows, as I've observed it, were put buyings. So last year, I would say there was an overwhelming skew towards call buyers versus puts, meaning there was more call open interest than put open interest and people speculating to the upside. And I would say in January, you saw a lot of put buying. Put buying was a big driver of the imbalance that you saw. And when you have that kind of activity where investors are buying puts, you have to assume the other side is the dealers are selling puts. Dealers are basically short gamma. And so if you're building the short gamma position over the course of the 30, 60, 90 days, and they become violently exposed, well, they have a tendency to actually be somewhat self-compounding that could create some dramatic effects. And I think that's ultimately what happened. There's just not enough volume, first and foremost, right now that we've seen with Bitcoin ETFs since the beginning of the new year, which hints towards there being a difficulty towards price consolidation, either upwards or downward. And yet there's these kind of oversized maybe options that are being bet on different parts of the curve where, it's a pretty fragile kind of system as we're experiencing it because of the volatility that it was at for so long.
Jeff Park's analysis ultimately challenges one of the most common instincts during violent sell-offs, the search for a single villain, the assumption that every crash must originate from a crypto failure, a hidden liquidation, or some catastrophic internal breakdown. Instead, Park points to something far less dramatic, but far more consequential. Bitcoin is no longer operating inside a sealed crypto ecosystem. It is now deeply embedded within traditional financial markets. That integration brings adoption, liquidity, legitimacy, but also something else: external volatility transmission, options markets, futures markets, dealer positioning, structural volatility selling, dynamics that have nothing to do with Bitcoin's fundamentals, yet increasingly dictate short-term price behavior. In other words, not every brutal move is a Bitcoin story. Some are simply market structure stories. And while traders wrestle with volatility, another battle is unfolding quietly at the regulatory level, one that could shape the next phase of crypto's evolution. Recent reports from Washington revealed that yet another closed-door meeting between banks and crypto firms ended without a deal. At the center of the conflict, stablecoin yield and reward rules, What makes this latest meeting important is not the continued disagreement, but the shift in the bank's position. Since this debate began in mid-January, banks have maintained a near-absolute stance. No rewards, no incentives, no exceptions. That changed in the latest meeting. For the first time, banking representatives showed limited willingness to consider exemptions, specifically for rewards tied strictly to transaction-based activity. It may sound like a small adjustment, but in negotiation terms, this is meaningful. It represents the first real concession from the banking side since the stalemate began. And more importantly, it signals that discussions are no longer locked in a stalemate. Positions are softening. For crypto firms, this is not a resolution, but it is a small, tangible victory. Still, the core friction remains unresolved. Crypto wants broad definitions of permissible activities. Banks want tightly constrained frameworks. And until compromise language is finalized, one of the most critical pillars of the U.S. crypto market structure remains uncertain, which feeds directly into the broader confidence problem already weighing on sentiment. For years, Bitcoin and the wider crypto market have operated in a fragmented environment defined by overlapping jurisdictions, inconsistent enforcement, and shifting interpretations. Uncertainty suppresses capital formation. Uncertainty deters institutional participation. Uncertainty fuels fear during downturns. Market participants are not just reacting to price declines. They are reacting to the absence of a predictable framework. The Clarity Act represents something markets desperately need: defined boundaries, clear asset classifications, clear oversight responsibilities, clear legal pathways for innovation, and perhaps most critically, retail investors, the very participants policymakers claim to protect, remain trapped in cycles of confusion. Zooming out, what we're witnessing is not simply a volatile market, it's a system in transition. Bitcoin evolving from a niche asset into a macro-integrated instrument. If this breakdown helped you see the market through a clearer lens, consider liking the video. It genuinely helps the channel. And if you're already subscribed, sincerely, thank you. Your support is what allows these deeper analyses to exist. Now I'd love to hear from you. Do you agree with Jeff Park's structural explanation? Do you think stablecoin yield restrictions are inevitable? And how important do you believe regulatory clarity is for the next phase of crypto? Drop your thoughts in the comments. Let's have a real discussion. Thanks for watching.